Welcome back to the deep dive. We have a heavy one today.
Yeah, this one feels different.
It does. And I don't mean heavy like, complicated textbook. Heavy, though we were definitely going to get into the weeds on bond markets. I mean heavy as in the weight of history.
That's a good way to put it. It's not just about numbers on a screen. There's a psychological weight to what's happening.
Exactly. Usually when we think about history being made,
Hmm.
our minds jump to these huge explosions, the cinema moments.
Right.
Pearl Harbor, the Kennedy assassination, the Twin Towers falling, those flashbulb memories where the entire world just seems to snap, it changes instantly, and you remember exactly where you were, what you were doing when you heard the news.
The singular events that cleave time into a before and an after. It's a very human way to process change.
It is. But today's deep dive, well, it challenges that whole framework. We've been analyzing a really fascinating and, frankly, a somewhat unnerving conversation between Alex Sadrunoff and Matthew Piepenburg from Gold Republic Global.
Piepenburg's work is always compelling. He has a way of connecting history, psychology, and markets that's pretty unique.
He really does. And their central thesis, the core idea, is that we are living through a historic turning point right now. Arguably, it's bigger than some of those events I just listed.
Yeah.
But, and here's the catch, it's invisible.
Or at least it's invisible to the naked eye.
Yes. Because it's not an explosion, it's what they call a slow drip.
And that distinction is just so important. It's everything, really. Human beings, we're wired to react to sudden shocks. A tiger jumping out of a bush, instant reaction, adrenaline, fight or flight.
Right, you don't have to think about
You
it.
don't. But a slow, creeping rot in the foundation of our house. We ignore it, we paint over the crack, we tell ourselves it's fine until the day the roof caves in. And Piepenburg uses this really compelling, albeit dark, metaphor to describe where the U.S. financial system is right now.
Oh, yeah. This one really stuck with me. He calls it a Stalingrad moment.
It's a heavy image.
It is. When I hear Stalingrad, I just think of absolute frozen destruction from World War II. It's about as bleak as it gets.
And it was. But he's not just using it for shock value. He's referring to the very specific strategic reality of that battle. Or, if you prefer American history, you could use the Battle of Gettysburg as a parallel. It's the same principle.
Okay, so what's the principle?
The point he makes is that in those battles, the losing side, the Germans at Stalingrad, the Confederates at Gettysburg, had already mathematically lost the war long before the fighting actually stopped.
You mean like the logistics were broken, the supply lines were cut?
Yeah.
The map just didn't work for them anymore.
Exactly. The final outcome was, for all intents and purposes, mathematically inevitable. But did they surrender immediately? Did they say, well, the spreadsheet says we lose, so let's pack it in?
No, of course not. They kept fighting for 2 more years.
And those 2 years were absolute carnage.
Just pointless destruction.
Pointless destruction. They created tens of thousands more casualties, massive destruction of infrastructure, and just prolonged the agony for everyone, even though the result was already baked in.
Wow. Okay, so he's saying the U.S. dollar.
He's arguing that the U.S. dollar and the current global financial dominance of the West have already lost. The mathematical war is over, the debt is too high, the trust is too low, the global dynamics have shifted. But the system is still fighting. It's still churning out propaganda about soft landings.
So we're in the 2 years of carnage after the war was already lost.
That's the argument. We aren't looking at a sudden, clean stop. We're in for a chaotic, drawn-out, and painful decline. A slow drip of decay.
That is, that's a lot to process.
Yeah.
But it sets the stage perfectly for what we're trying to do here today. Our mission for this deep dive is to try and decode the signals that Piepenburg says are screaming crisis, while most of us are just, going about our day worrying about grocery prices.
Right, to see the rot in the foundation before the roof caves in.
Exactly. So we're going to look at the physics of gold, the weirdness happening in the bond market, and this whole concept of trust. Because, and this is where it gets really interesting for me, he argues this isn't just about money, it's about psychology.
It absolutely is. You can't separate economics from human behavior, from fear and greed and trust. They're the same thing. And that leads us right into the core theme of their discussion.
Let's do it. Section 1, the crisis of trust and what I'm now calling the martini economy.
I like that. The martini economy.
So Piepenburg makes this point, he really hammers it home, that the root of our financial mess isn't just numbers on a spreadsheet or some complex financial instrument. It's something much more fundamental. It's the slow death of trust.
And he brings some just staggering numbers to back that up. It's not just a feeling he has. If you look at the Kennedy era in the United States, so we're talking the early 1960s, public faith in government was hovering around 80%.
80%? 80%. That sounds like a different planet compared to today. I can't even imagine that.
It really does. It's almost unbelievable. But back then, people generally believed the institutions were, at least trying to work for them. They believed the system was basically competent and honest.
And today? What's that number today?
It's less than 20%.
Wow. From 80 to less than 20. That is a collapse. That's not a dip or a trend. That's a structural failure.
Precisely. And he's very clear to point out that this is not a partisan issue. This isn't about whether you're left or right or which party is in the White House. It is a fundamental structural decay in the belief that the system itself is honest or functional.
And okay, so why does that matter for your wallet? For the economy?
Because when you lose trust in the issuer of the currency, in this case the government, you eventually lose trust in the currency itself. What is money, after all? It's just a promise. It's a social contract.
It's an IOU.
It's an IOU from the government.
Yeah.
And if you don't trust the guy writing the IOU, then eventually that piece of paper in your hand is worthless.
Which brings us to my absolute favorite analogy from this entire deep dive, the one too many martinis theory of economics. I feel like we've all been there personally, but maybe not, as a nation.
It is such a vivid image, and it explains the concept of quantitative easing, which is a very fancy, intimidating term for money printing, better than any textbook I've ever read.
Okay, so break it down for us. How is the U.S. economy like a guy at a bar?
All right, so imagine the government is at a bar. The economy slows down, things get tough. Maybe it's the 2008 crash, maybe it's the COVID lockdowns. So the government, to feel better, orders a martini.
The first $1 trillion.
The first trillion, the stimulus. And just like that first martini, it feels great. I mean, it really works. You get that initial buzz, the conversation starts flowing, everyone at the bar looks smarter and more attractive, the stock market perks up, people feel richer because there's cash in their account.
The liquidity hits the system, and everything just feels fluid and happy.
You're charming, you're buying rounds for your friends, life is good, you feel like a genius.
Okay, I'm with you so far. What's the problem?
The problem, as Peipenberg points out, is that the U.S. and Japan, they're the two biggest offenders here, they didn't stop at one or two drinks. They liked that feeling so much that they stayed at the bar until 4 in the morning.
They just kept ordering more rounds.
More and more. More QE. More stimulus. More debt. They kept the party going long after they should have called a cab. And now, to quote him directly, the thinking is affected.
The thinking is affected. That is such a perfectly polite, almost clinical way of saying they're stumbling, slurring drunk.
It is. The judgment is gone. They're making bad decisions. And now we are facing the inevitable, sickening morning after. You can't stay at the bar forever. You can't print your way out of a debt crisis permanently without facing the consequences.
So where are we now in this analogy?
We are, according to Peipenberg, on the embarrassing walk of shame home.
Oh, the walk of shame. The sun is too bright, your head is pounding, you're rereading texts you shouldn't have sent.
Exactly. And the nausea is setting in. He uses a phrase, and excuse the graphic nature here, but it's effective. He says, the puking sound of the markets hasn't fully started yet, but the nausea is definitely there. You can feel it.
So this whole narrative we keep hearing from the Fed and the media about a soft landing, this idea that they can just raise rates a little, cool off inflation, and everything will just settle down nicely without a recession.
Yeah.
He thinks that's nonsense.
He thinks it's a complete fantasy. He calls it naive. It's the alcoholic telling you they can have just one more and be fine to drive. You don't drink until 4 a.m. and then wake up fresh for a marathon. You pay the price.
And the price, the hangover in economic terms, what is that?
It's inflation that won't go away. It's social unrest. It's a bond market that stops behaving the way the central planners want it to. It's the bill for the party coming due.
Well, speaking of things not behaving, let's talk about the canary in the coal mine. Because the source material spends a lot of time on Japan. And I know, for a lot of listeners, hearing Japanese bond market might sound like a cue to go take a nap.
It's not usually the sexiest topic at a dinner party, no.
Definitely not.
Yeah.
But Peipenberg argues, really forcefully, that if you live in the U.S. or Europe, Japan is actually the single most important thing to be watching right now. Why? Why does what happens in Japan matter to a guy living in Ohio?
Because Japan is the litmus test. They are our ghost of Christmas future. They are further along the timeline of this exact debt experiment than anyone else on the planet.
So if we're at 4 a.m. at the bar?
Japan has been there since yesterday afternoon. They're passed out in the corner booth.
Okay, so they're the trendsetters for bad decisions.
In a way, yes. Think about their history. Japan's massive bubble crashed way back in 1989. And what have they done for the 30-plus years since? They've engaged in QE gone wild. They invented it, really. They printed money aggressively to keep their interest rates pinned at zero.
They do something called yield curve control, right?
Yes, YCC. It's an insane policy where the central bank basically promises to buy an unlimited amount of government bonds to force the interest rates to stay at a specific low level. It's the ultimate act of market manipulation.
And this mattered to the rest of the world because why do we care if their rates are zero?
Because it made Japan the prop desk for the entire global economy. This is a really key concept to understand. Because their interest rates were artificially forced to zero, investors all over the world, hedge funds in New York, banks in London, would borrow Japanese yen for free, basically.
Because it was the cheapest money on earth.
The cheapest. And they'd take that free yen and use it to invest in U.S. stocks or Australian real estate or Brazilian bonds or whatever yielded a higher return. It was a massive global subsidy.
That's the carry trade, isn't it?
That's exactly what the carry trade is. It's a flood of free money, courtesy of the Bank of Japan, that inflated asset prices all over the world for decades. Japan was the global ATM, providing cheap cash to everyone.
But the ATM is starting to malfunction.
It's worse than that. It's starting to ask for the money back. The source points out that for the first time in decades, Japanese bond yields are screaming upwards. The market is fighting the central bank. They're seeing these things called sigma moves.
Sigma moves. That sounds like frat boy terminology, but I'm guessing it's math.
It's statistics, yeah. A sigma refers to a standard deviation from the norm. A 1 or 2 sigma move is normal market volatility. A 3 or 4, or in some cases a 6 sigma move, is a statistical anomaly that in a normally functioning market should effectively never happen.
Like winning the lottery 3 days in a row.
Or seeing a unicorn walk down Wall Street. It's a black swan event. But these never should happen moves are now happening with increasing frequency in the Japanese bond market.
And what does that signal? What's the message there?
It signals that the peg is breaking, the market is finally overpowering the central bank. It signals that trust in the Bank of Japan's IOUs is collapsing. Even their own citizens are no longer blindly buying the government debt at the price the government wants. They are demanding a higher return for the risk.
And when yields rise in Japan, that cheap money that was flowing into the U.S.
It stops, and then it reverses. The hedge funds have to sell their U.S. stocks to buy yen to pay back their loans. The fire hose of cheap credit gets turned off, and then it turns into a giant vacuum cleaner, sucking liquidity out of global markets.
So the U.S. loses its cheap credit line, and assets start to fall.
That's the terrifying implication. And it's so important because the U.S. is on the exact same trajectory. We are following Japan's playbook, just with a lag of about 15 years. Peipenberg has that great line. He calls the U.S. dollar the cleanest dirty shirt in the laundry basket.
I love that image. We look better than the yen or the euro, but we're still fundamentally dirty.
We are suffering from the exact same debt sickness. And the sponge, that's another great metaphor he uses, the global sponge that used to soak up all the U.S. debt we issue is drying up. China, Japan, the oil nations, they're not buying our bonds like they used to. The world is running out of capacity, or maybe just the willingness to fund our deficit spending.
This brings us to a really crucial distinction that the source makes. We tend to think of the Federal Reserve, Jerome Powell and his crew, as the masters of the universe, that they control the economy like a thermostat. But Peipenberg says, no, the bond market is the real boss.
That is a critical realization for anyone trying to understand what's happening. Central bankers, well, they suffer from a fair bit of arrogance, a god complex, you could say.
They think they're in control.
They believe that by tweaking one little interest rate, the short-term Fed funds rate, they can steer the entire multi-trillion-dollar economic machine. But they only control the very, very short end of the curve, the long end. The 10-year bond, the 30-year bond. That is controlled by the market. That is controlled by real-world supply and demand.
So if no one wants to buy our 30-year bonds because they think our long-term finances are a disaster, the interest rates on those bonds go up, regardless of what the Fed does with short-term rates.
Exactly. The bond market can and will overrule the Fed. And that is what is starting to happen. The bond market is signaling that our debt is unsustainable. It's the market's way of revolting. And when the bond market revolts, the government has a very big, very ugly problem.
Why? Because if those long-term interest rates go up too high,
The government literally cannot afford to pay the interest on its own debt. The entire federal budget gets consumed by interest payments. It's game over.
which leads us perfectly into Section 3, the Fed's trap, or as Piepenburg so brilliantly calls it, Tweedledee and Tweedledum.
I loved this part of the conversation. He's referring to the complete illusion of political choice when it comes to the Federal Reserve.
Yeah, his point is basically that it doesn't matter if it's a Democrat or a Republican in office. It doesn't matter if the Fed chair is Powell or Brainard or someone else entirely. The math is now dictating the policy, not the person.
Right. He says any new sheriff in town at the Fed must be dovish. Now, dovish is Fed speak for favoring low interest rates and, when necessary, printing more money. And this isn't because of their ideology, it's because of mathematical survival.
So let's walk through the binary choice here, because he lays it out so clearly. He says the government has two doors they can walk through, and they absolutely cannot walk through both. They are mutually exclusive.
Okay, let's look at door number 1. The sign on this door says, "Save the currency."
Okay.
This is the Paul Volcker option. Back in the late 70s and early 80s, inflation was out of control, so the Fed chair, Paul Volcker, raised interest rates to 20%. He made money incredibly expensive. He crushed inflation and defended the integrity of the dollar.
Okay, that sounds responsible. That sounds like what a prudent central banker should do. So why don't we just do that now?
Because back in Volcker's day, the U.S. national debt was less than $1 trillion. It was manageable. Today, we have over $35 trillion in debt, and that number is growing exponentially. If you tried to pull a Volcker today and raise interest rates to, say, even 8 or 10% to fight inflation, the annual interest payments on the national debt alone would become so high that they would consume the entire federal budget, more than we spend on the military, Social Security, everything combined.
So we couldn't pay our bills.
We couldn't pay anything. The U.S. government becomes instantly insolvent. The stock market crashes by 80%. The banking system implodes. The system, as Piepenburg puts it, coughs, smokes, and pulls off to the side of the road. It's a full-blown systemic collapse.
Okay, so door number 1 is the system crashes. That doesn't sound like a very popular choice. What's behind door number 2?
Door number 2 is labeled Save the Bond Market. This is the other option. To keep the government solvent, you have to keep its borrowing costs, interest rates, artificially low.
But you just said the market is starting to demand higher rates. So if regular investors won't buy the debt at those low rates, who buys it?
The Fed.
The Fed buys it.
The Fed steps in as the buyer of last resort. They print money out of thin air to buy the government debt themselves. This is the definition of quantitative easing. Or, more accurately, debt monetization.
And the result of that. What happens when you go through door number 2?
You save the system from immediate collapse. The government checks keep clearing, the military gets paid, Social Security checks go out, but you sacrifice the currency. You debase the dollar by printing trillions of new ones to pay the bills. You create massive, persistent inflation.
So on one hand, you have an immediate catastrophic crash of the economy. On the other hand, you have a slow, grinding destruction of the money's value.
Correct. It's a Sophie's choice for policymakers, a crash or inflation. And the verdict from all of human history and from Piepenburg is that governments always choose door number 2.
Always.
Always. They will always choose inflation over an immediate default. It's politically easier to make everyone's money worth a little bit less every year, that's this slow drip again, than it is to get on national television and admit that the government is broke.
This is where he brings up the Weimar comparison. Weimar Germany, you know, the famous images of people using wheelbarrows full of cash just to buy a loaf of bread. Are we actually looking at something like that?
He offers a very careful and nuanced take here, which I appreciate. He asks the question, is America in 2026 the Weimar Republic? And his answer is no, not exactly.
Why not?
Because the United States has the world reserve currency. It's our exorbitant privilege. We have a massive structural advantage that post-WWI Germany did not have. We can export a lot of our inflation to the rest of the world because everyone needs dollars to buy oil and trade.
Wait, there's a but.
There's a huge but.
Yeah.
He calls it we're in a slow Weimar. He argues we have been in a slow-motion Weimar Germany since 1971, the year President Nixon took the U.S. dollar off the gold standard.
So it's not a hyperinflationary explosion overnight.
No, it's a 50-year slow grind debasement. But the direction of travel, the fundamental policy of debasing the currency to pay for debts that can never mathematically be paid back with sound money, is identical.
And this brings us to the one asset that has been screaming about this problem for a very, very long time. Gold.
The ultimate truth teller.
Now, Before we even get into the price, I thought his framing of gold was really refreshing and important. He says it's not a bubble, it's a barometer.
That is such a key shift in mindset for people to make. A lot of investors, they look at gold hitting record highs, $2,600, $2,700 an ounce, and potentially much higher, and they think, oh, it's expensive, I missed the boat, it's a bubble about to pop.
Right, the fear of buying the top.
Exactly. But Peipenberg argues the complete opposite. He says gold isn't really rising, the dollar is falling. Gold is just the constant. It's the stable ruler. If the thing you're using to measure with the dollar is shrinking, then of course the object you're measuring is going to look bigger.
He compared it to NVIDIA or Bitcoin,
Yeah.
right? That was a great point.
He did. He said people aren't shocked when NVIDIA goes up 100% a year or Bitcoin moves $10,000 in a month. We've been conditioned to accept that kind of volatility in tech and crypto, but gold moves $100 and everyone freaks out that it's a bubble. It's a psychological bias.
But here's where it gets really, really interesting. Who is buying all the gold right now?
And this is the tell. It's not just the traditional gold bugs with bunkers in their backyards anymore. Not by a long shot.
No. The biggest buyers on the planet right now are central banks.
The big boys. The monetary authorities themselves, China, Russia, India, Poland, Singapore, Turkey, they are buying gold hand over fist at record rates, and they are not slowing down. And Peipenberg says they are building the ark before the rain.
I love that line, building the ark before the rain. It's so evocative.
It's telling, isn't it? It implies they see the storm clouds gathering. They are stacking physical gold as a strategic reserve asset because they know that the paper system, the bond market system we just talked about, is in the process of resetting. They are hedging their bets against the very system they are supposed to be managing.
That is deeply concerning. When the lifeguard starts putting on a lice jacket, you should probably get out of the pool.
That is a fantastic analogy, yes. When the central bankers themselves are buying physical gold, you really need to pay attention.
Okay, now let's talk about the red button. This part of the discussion sounded like something out of a techno thriller. Peipenberg mentions a secret weapon or a nuclear option that the U.S. Treasury has at its disposal.
This is one of the most fascinating and honestly under-discussed parts of the entire deep dive. So we know the U.S. Treasury holds a massive amount of gold, Fort Knox, West Point, all of that. We supposedly have about 8,000 tons, the most of any single nation. But here is the kicker.
What's the kicker?
On the official government balance sheet on the books, that gold is valued at $42 per ounce.
$42. You couldn't buy a nice dinner for $42, let alone an ounce of gold, which is trading at, what, $2,600 right now? Why 42?
It's a bizarre historical relic of accounting from the 1970s. They just never updated the book value. It's been sitting there at $42 an ounce for 50 years. But, and this is the key, there is a mechanism, and the Fed has even hinted at this in some of their obscure manuals, where they could officially revalue that gold overnight to the current market price. Or even higher.
Higher.
Say $20,000 per ounce. Just pick a number.
Whoa, okay. Why on earth would they do that? Just to make the balance sheet look better?
Not just to look better, to save it. Think about the basic accounting equation. Assets equal liabilities plus equity. The U.S. government has massive, overwhelming liabilities, that $35 trillion in debt. If you suddenly say your assets, your 8,000 tons of gold, are now worth $20,000 an ounce instead of 42, what happens?
The asset side of the ledger just explodes upwards.
It explodes. The U.S. Treasury suddenly has trillions and trillions of dollars in new equity on its balance sheet. It's like finding a winning lottery ticket worth trillions in an old pair of jeans you forgot about.
So they could use that found money to pay down debt without technically having to print new dollars from scratch.
Exactly. It creates massive liquidity without the immediate inflationary hit of running the printing presses. It's a bailout of the system using the gold they already have in the vault. It restores the government balance sheet to solvency instantly. Poof.
But there's a catch, right? There's always a catch with these things.
The catch is enormous. First, it creates a permanent new floor for the price of gold. If the U.S. government officially says gold is worth $20,000, then the days of buying it for $2,000 or $3,000 are gone forever. It fundamentally reprices everything else in relation to it. And second, as Kissinger famously warned, it raises the terrifying question, who actually has the most gold?
Ah, because other countries have gold too. This isn't just a U.S. thing.
Right. If you remonetize gold globally, you empower whichever nation holds the most of it. We, the U.S., claim to have the most. We publish our numbers. But China and Russia have been incredibly opaque about their true holdings. for decades. They act as the domestic buyer for all of their massive mining production. They don't export any of it.
So China could have way more than they admit.
Some serious analysts suspect that if you count all the gold within China's borders, they may have more than the U.S. So if we hit that red button thinking it saves us, we might accidentally hand the keys to the new global financial system to our biggest geopolitical rival.
Talk about a high-stakes poker game, my God.
It's the ultimate game. It's a move of last resort. But Peipenberg's point is that it is one of the few mathematical ways out of this debt trap without a complete and total default.
Okay, that is a mind-bender. Let's move from the heavy battleship of gold to, what did he call silver, the speedboat?
Yes, the silver speedboat.
I love the distinction he draws between the two metals. He says gold is the mama metal, the juggernaut. It's stable. It's for preserving your wealth over generations. Silver is, well, he called it bipolar.
Bipolar and not for widows and orphans. That was his explicit warning. Silver is incredibly volatile. It whipsaws. It can drop 10% in a day and then go up 15% the next. But that's also why people love it. In a real bull market for precious metals, it moves much faster and further than gold does.
So what's driving silver specifically right now? Is it just following gold around like a little brother?
It usually does follow gold. That's its primary driver. But right now, it has a dual engine. That's what makes this moment for silver so unique. One engine is the monetary demand. It moves with gold as a hedge against inflation and currency debasement. But the other engine, which is getting bigger and bigger, is industrial demand.
Right. Gold is mostly just jewelry and money. It sits in vaults.
Exactly. Silver is in everything modern. It's the most electrically and thermally conductive metal on the planet.
Solar panels, AI data centers, electric vehicles, smartphones.
All of it. It's crucial for the entire green agenda, and it's essential for military tech missile satellites. It's now officially classified by many governments as a mineral of national security. And here's the crucial difference. When you use silver in a Tomahawk missile or a solar panel, it's often consumed. It's gone. It's used up in tiny amounts that aren't economical to recycle. It doesn't go back into a vault.
So you have this massive inelastic industrial demand that is squeezing the available supply at the exact same time that investors are starting to buy it for monetary protection.
And Peipenberg mentioned a squeeze. For years, maybe decades, there has been widespread talk of manipulation in the silver market, big banks using paper contracts, paper shorts to keep the price artificially low. But Peipenberg argues that the physical industrial demand is now so high that the manipulation is breaking.
How so?
The paper shorts failed because industry companies like Samsung or Tesla or solar panel manufacturers, they looked at the low price and said, great, it's on sale, and they just bought up all the available physical metal. You can't satisfy a factory's needs with a paper contract. You need the actual metal delivered to your door.
He threw out some pretty wild numbers for silver's potential price, didn't he?
He did, but he was careful to ground them in math, not just hype. He looked at the M2 money supply, which is basically all the cash and checking deposits in the system. He said if you adjust for the massive increase in money supply and for inflation, for silver to reach its previous highs in real terms, it should mathematically be around $250 or even $900 an ounce.
900? Wow. But he did clarify he's not predicting $900 this year.
No, absolutely not. And that's really important. He's not a hype salesman. He's saying that $200 or $300 is a mathematically reasonable target, but he warns over and over that it will be an incredibly bumpy ride to get there. He actually suggests a strategy. He suggests using the gold to silver ratio to trade between them. When silver gets very expensive relative to gold, when the speedboat races way, way ahead of the battleship, you swap your volatile silver for stable gold to lock in the gains and the stability.
So ride the speedboat, but sleep on the battleship.
That is an excellent way to put it. Perfect advice.
All right, let's zoom out a little bit. We've talked about money, we've talked about metals, but none of this exists in a vacuum. It all exists in the messy world of geopolitics.
Yeah.
And there was this quote in Section 6 that just sent the chill down my spine. The fatal friend doctrine.
That's Henry Kissinger again. He had a way with words. To be an enemy of America is dangerous, but to be a friend is fatal.
Ouch. I mean, that is just brutally cynical. What does that mean in this context?
Peipenberg was discussing Europe. Specifically, he was talking about Germany. He argues that Europe, led by Germany, followed U.S. foreign policy on Ukraine and the Russian sanctions almost blindly, without question. And what was the result?
The U.S. economy did okay.
The U.S. economy, and especially the U.S. energy sector, did just fine. But Europe and Germany specifically got absolutely crushed. They lost their access to cheap Russian energy, which was the bedrock of their industrial might. They're now facing widespread deindustrialization, with iconic companies like BASF moving plants abroad. Their economy has completely stagnated.
So being the loyal friend of the U.S.
Mhm.
meant absorbing the economic blowback of U.S. foreign policy decisions.
Correct. The lesson that the rest of the world is learning is that the U.S. has permanent interests, not permanent friends. And this realization is fueling a massive global shift. It ties directly into the weaponization of the dollar.
This was the moment in 2022 when the West seized Russia's foreign currency reserves, right?
Yes, that was a watershed moment in modern financial history. When the U.S. and Europe froze $300 billion of Russian sovereign reserves, it sent a clear, unambiguous message to the entire rest of the world, to China, to Saudi Arabia, to Brazil, to India.
And what was that message?
The message was, your money, your dollar reserves that you have worked hard to accumulate, are not safe if you ever disagree with U.S. foreign policy.
It turned the dollar from a neutral global utility, like the phone system, into a political weapon that could be turned against you.
Exactly. And you can only play that card once. Because the moment you do, everyone else on the planet immediately starts looking for an alternative payment system. And that is what has massively accelerated de-dollarization. It's why the BRICS nations are working so hard to trade in their local currencies. It's why they are all buying gold. They want a settlement layer for international trade that Washington can't turn off with a switch.
So we are seeing a great fracturing, a global split, the West versus the rest.
A bifurcation of the global economy. The West and Europe is largely debt-based and service-based, and the East and the South, the BRICS alliance, is increasingly manufacturing-based and commodities and gold-backed. And Peipenberg points out a funny but also kind of painful contrast here regarding innovation between the two Western blocs.
The bottle caps.
The bottle caps, yes. He brings up the meme that's been going around. The U.S. has SpaceX literally catching reusable rockets out of the sky with giant robotic chopsticks. It's pure dynamism and innovation.
And Europe?
Europe has new regulations that tether plastic bottle caps to the bottle so you don't lose them.
I hate those caps. I really do. They scratch my nose every time I try to take a drink.
It's a perfect, if slightly silly, symbol of stagnation versus dynamism. But his bigger point is that both the innovative U.S. and the bureaucratic Europe are trapped in the exact same debt web. Innovation alone can't fix a debt crisis of this magnitude. SpaceX is an amazing achievement, but it can't pay off $36 trillion in debt.
So to recap, we've covered the martini hangover, the Japanese bond canary, the Fed's impossible Sophie's choice, the red button theory of gold, and the fracturing of the entire global order. It is a lot.
It is a lot. It's a comprehensive slow-motion unraveling of the entire post-World War II order.
So let's try to bring it all home, the outro. Peipenberg summarizes this era we're entering as the new abnormal.
Right. And that's such an important frame. We need to stop waiting for things to go back to normal because that normal is never coming back. The party, that 70-year era of cheap debt, low inflation, and easy globalized growth, is over. The bar is closed.
The hangover is our new reality.
The hangover is the new abnormal. And that means things like persistent inflation, policies like yield curve control, financial repression, and social unrest are going to be features, not bugs, of the system going forward.
And in this new abnormal, gold isn't just another investment to try and make money on.
No. He calls it the honest asset in a fundamentally dishonest system. When trust evaporates from paper promises, it has to condense somewhere. And historically, it always condenses into gold. It's not about getting rich. It's about preserving your purchasing power while the currency is being systematically debased around you.
I want to leave our listener with one final provocative thought that we touched on earlier, but I want to really drill into it. That red button scenario with gold.
Let's do it. It's the most important takeaway, I think.
If the U.S. government does one day decide to revalue its gold holdings to, say, $20,000 an ounce to save the system, what happens to the person who holds no gold?
That is the absolutely terrifying question, isn't it? Think about the math of it. If gold goes from, say, $2,500 to $20,000 overnight by government decree, that is a massive, instantaneous transfer of purchasing power. The currency, the dollars in your bank account, in your pension, would be catastrophically devalued relative to that real asset.
So if you hold the asset being revalued, you're protected. You float up with the tide.
You're more than protected, you benefit enormously. But if you don't hold it, if all your savings are in dollars, You are the one paying for the revaluation. Your savings, your purchasing power, are effectively diluted, confiscated to bail out the state.
It's a massive wealth transfer from those who trust the paper promises to those who hold the physical metal.
Historically, that is exactly how these resets happen. It's the ultimate invisible tax on savers.
Peipenberg had that great closing line. He said, "Don't take our word for it. Just look at the history of paper money since 1971.
It's a graveyard of failed fiat currencies. The dollar has been the remarkable exception, the last man standing, but not the rule. And exceptions, by definition, don't last forever.
Well, on that cheery note. But seriously, this deep dive isn't meant to be about fear. It's about awareness. It's about learning to see the slow drip before it becomes a flood.
Keep your eyes on the horizon, and maybe check on your own insurance policy before the rain really starts.
That's it for this deep dive. Thanks for listening, and we'll catch you in the next one.